where we are being told that under the dividend discount model, it starts with the premise that the stock price should be equal to the sum of its current and future cash flows after taking the time value of money into account. So the time value of money discount factor that we are using to discount project is the
Yeah.
same discount. If it is 10%, it is the same discount that we are using to be able to make the decision on the price of the share. For example, here we are saying if you have an investment of 2,000 today at
Yes.
10%, this will lead to 2,200 at the end of the year, right?
Yeah.
So the present value is 2,200 at the required rate of 10%, which is
Yeah.
2,000. So the initial investment of 2,000 is, if it is deducted, this figure will arrive at NPV, which is equal to 0. When you discount bill,
Yes.
you see if you are investing this 2,000
Yes.
at 10%, it will give you a return. This is now the amount in year one, right?
Yeah. Yeah.
This is the amount in year zero when you are making the investment.
Yes.
So if you are making the investment now, remember this is the present value and this is
Yeah.
the future value.
Yeah.
So when you discount this, the future value, when you discount at 10%, it will
It
now
should.
be equal to 2,000.
Yes.
So 2,000 minus the inflow of 2,000 will give you an NPV equal to 0.
Yeah.
It's clear.
Yeah.
So the implication here is that a 0 NPV means that the amount of money that you have invested has already been repaid, right?
Yeah.
Then it also implies that if you have an NPV which is positive, it will give you a return which is better or more than 0.
Yes.
And a negative one, it is like it is eroding your investment.
Yeah.
It's clear, eh?
Yes.
Then here we have an illustration where we are being told that an investor expects to invest in a company and get, this is supposed to be 1.5 bill,
Yes.
1.5 as dividend from a share next year. That is next year, year one.
Yeah.
And he also opts to sell off the share at 30 shillings after holding it for 1 year. So he's also selling the share after 1 year.
Yeah.
Assuming now we have a required rate of return of 20%. So there is something missing. The required rate of return here is 20%. What is the present value of the share? You see, you are making the decision today.
Yeah.
And how much should he be willing to buy a share of the company? So you will now use this formula. This is now the discounting model of valuation. The value of the share will be equal to the dividends you discount by the time when you are getting this dividend,
Yeah.
plus the selling price you also discount at the time when you are selling, right?
Yeah. Yeah.
So this dividend is being received in year one. So you discount at 20% year one,
Yeah.
plus 30, which is now the selling price, which is being done after 1 year, which is now year one.
Yes.
So you now find this is now the present value of the share.
So usually when you are getting the value of a share, it is dividend.
You see, the gains that you get, Bill,
Yeah.
in terms of the share is the dividend and the capital gains.
Yeah.
These are the only benefit that you get from shares.
Yeah.
So when he is selling, we are expecting that he is supposed to get some capital gains.
Yeah.
It's clear, eh?
Yes.
So now this is now the present value of everything that you will be able to get, the dividends plus the sell, which
Sure.
will now give us the value of the share.
Yeah.
You are getting it, eh?
Yes.
So now we have been told the value he would be willing to pay for the share should be 26.25 or less. Because if you invest more than this, then you are not going. You are going to be worse off. Deal, eh?
I can't get that clear.
What I'm saying, eh?
Yes.
We have said the intrinsic value of the share, which we are now computing, is 26.25, eh? And this is now the value of the share. And this value of the share, we have factored capital gain
And the dividend.
and the dividend. So you see now, this is the present value. We are making the decision now
Yeah.
based on the information that we have of the dividends after 1 year and also the selling after 1 year.
Yes.
So this is now like the intrinsic value of the share of 26.25.
So, what is intrinsic? Intrinsic value, is it the net present value?
It is like the net present value of the share.
Okay.
So in this case, Bill,
Yes.
if today now you are making decision, assume now you are the person who have been told buy a share which will give you 1.5 after 1 year, and after 1 year you will buy, you will sell the share at 30 shillings. So this is now the intrinsic value of the share, Bill.
Yes.
So you should not be willing to buy this share more than 26.25.
Yeah.
Because if you buy it more than this, it simply means your wealth will not be maximized.
Yeah.
You are getting what I'm saying?
Yeah. But if you are to sell it, it should be above that.
If you are,
If you are to sell the same
you
share.
see the selling price we have been given,
Yeah.
it is 30 shillings
Yeah.
after 1 year.
Yeah.
The dividends after 1 year we have been given is 1.5 shillings.
Yeah.
So the decision that we want to make
Is a buy decision.
is like the buying decision. How much should you buy the share?
Sure.
So what we are saying, if the market, now we have discounted this. It's like now we are making the decision.
Yes.
So if now this share is being sold more than 26, like assuming now it is being sold at 27,
Yes.
then it will be a bad decision to buy this share
Sure.
because your wealth will not be maximized.
That
But
is true.
if it's at 25, then your wealth will be maximized because the intrinsic value is higher.
I think it's clear.
Clear, eh?
Yes. But I don't know if this falls under what we've covered. Let me just read it. There is a question I saw somewhere here.
I think that is under valuation.
Yeah, it's under valuation. The question is,
Uh,
Explain 4 features of an ideal investment appraisal method. Yeah.
But you see, that is wide. It's not only limiting to. It's not limiting to capital decisions.
So in this case, what are the ideal investments?
If we are talking about shares, securities,
Yeah.
then you should be able, for example, to invest in a project that is giving you that you're investing less than the intrinsic value of the share.
Sure.
Two, you should be investing in projects that are giving you a positive NPV.
Sure.
You can give several other cases.
So for example, when we are looking at now the capital budgeting,
Yes.
if we leave alone the shares, can you give examples like the method that we used, like
Like
NPV, payback method?
Yeah, it is basically based on that.
Okay.
Even the internal rate of return, the
So
projects that we invest.
okay, so it's more of giving the decision based on the method that you've used.
Yes, but it is not limited to capital budgeting.
Okay.
It is even open to other investment like shares.
Sure.
It's clear.
Yeah. Acha nikusumbue tu kidogo. There is another question that I saw here.
Okay, no problem.
Let me just look for it. It was on the intrinsic value. I can't be able to see it, but once I get it, I think
Just look at it because when we'll be discussing the valuation,
yes.
we will have different methods that you'll be able to see that is being applied in valuation.
Sure.
It's a topic on its own. So again, we
Yeah.
have this other question here. Bill?
Yes.
Where you are being given almost the same thing. An investor intends to invest in XYZ company and expects to get 3.5 for 4.5 as dividends from a share during the next 3 years and opts to sell it off at 75 at the end of the third year. And the required rate of return is 25. So here we are supposed to use that discounting method to determine the intrinsic value of the share. So it's almost related. You get dividends, 3.5 at 25% discounting rate. Year 2 dividend is 4, the same discounting factor. Year 3, they are getting dividends at the same time. That is the time when they are selling the share. So we have 4.5 at 25, year 3, discount at year 3, 75. So this is now the intrinsic value of the share.
Yes.
It's clear?
Yeah. I have a question on the same, on intrinsic value.
Yes.
Actually, it is like, can I read the entire question?
Please do.
Bundacho Limited generated 50 million profit after tax in previous financial year. The firm adopts 40% payout ratio as its dividend policy. The total number of issued
50%.
Yeah. The total number of issued ordinary shares is 10 million.
Mm-hmm.
Then the company has a potential investment opportunity. If undertaken, dividends are expected to grow at a rate of 10% each year for the first 3 years and then stabilize at the rate of 5% each year.
Mm-hmm.
Thereafter in perpetuity.
Perpetuities. Perpetuity.
Yeah.
So here, this one, Bill,
Yes.
the best method used is known as the Gordon. The Gordon model.
Yes.
So just read
Then the last one, the last thing is the investor's minimum required rate of return is 18%. Then the question is required the current intrinsic value of the share.
Mm-hmm.
Yeah.
So here we are supposed to use the Gordon model. Bill, you can hear me?
I can hear you.
So the Gordon model will be able to give us a percentage that will compare with this 18%.
Yes.
Then from there, we can now be able to say whether it's a good or bad investment in shares.
Okay.
So this is limited to valuation of shares, which is a topic as a stand alone.
Okay. So there is a topic by the name valuation of shares.
Yes, it is there. Valuation of shares.
Okay.
Mm. So what will happen?
Yes.
We look at sources of finance.
Yes.
Then after sources of finance, there's another topic known as valuation of shares. That is now where you see all the methods that are applicable. So it will depend with the information that is provided that
Yes.
determines the choice of the method.
Sure.
It's clear. Eh?
Yes.
So I think that all that tries to explain the relationship between the maximization of wealth of the shareholders and the capital budgeting.